The majority of the stock market is in the green and up today, even when we look at the Fear and Greed Index, where we are right in fear territory. And what we have seen are 4 stocks that Wall Street are buying. We're going to take a look at each one. Now, these have a very strong buy rating from Wall Street on each of them. We'll look at the historical performance, understand how well they've performed. We'll talk about their dividend safety. We'll look at their supporting underlying metric. And for each one of these, we are, as always, going to put them through the valuation model, getting to both our intrinsic value as well as our acceptable buy, whilst incorporating our margin of safety, and see what exactly is the upside percentage that Wall Street see over the next 12 months. So the first one we are looking at, it is Emerson Electric, ticker symbol EMR, and we have a double strong buy rating, Wall Street and Quant, with a buy from Seeking Alpha. It is trading in the upper end of the 52-week range with a forward yield just under 2% and a forward P of around 19.5. For context, S&P is around 22.5, and we'll look at the sector to see what that is trading at for more relevancy. Over the last 12 months as well, very strong, up 24%, and if you've been a long-term shareholder of EMR, you would be up, although very poor, just 59%. It would be slightly higher if you were reinvesting those dividends. In terms of dividend safety, well, 78 score, it does look to be safe. Market cap, 61 billion. It is a large cap company, and it was reaffirmed just a few weeks ago. Safe rating, meaning dividend cut does look to be unlikely. Now, for those that see a recession inbound, well, last recession, great recession in fact of 07-09, they increased the dividend. They had negative 21% recession sales. Do bear in mind, S&P was around negative 12, and they had a near S&P return, negative 52, S&P itself returning negative 55. Dividend growth, not a very nice picture to paint here. Only 1% increase last November, 1% on average over the last 5 years. So that is a below inflationary target that we want to see of 4% or more. And over the last 20 years, 5%. So pretty poor across the board. But what we do note is they are a dividend king. They have increased those dividends for the last 66 years. Now, one part of our analysis in today's episode for each one of these stocks is looking at dividend yield theory. Now, this states a company is undervalued when the current yield sits above the 5-year average. So, in fact, we have a signal of overvaluation on the yield. However, undervaluation on the P, as it does sit 18.5, lower than the 5-year average of 19.8, and we do note marginally lower than the sector of industrials at 19. Now, do bear in mind, we're not looking at any of these models in isolation. We will conclude towards the end. As always, free cash flow payout is what we draw your attention to, the earnings susceptible to manipulation by management through accounting, and below 60% is what we want to see. Now, one of the reasons we always bang on about the free cash flow, not the earnings, we can spot impending dividend cuts, and what we would say a red flag indicator, 2023, Emerson Electric paid out significantly more in dividends than they generated in free cash flow. What we would say, however, is in 2024 for the annual report, they are expecting to bring this down to 39%, a lot more in line with what we have historically seen from this company. Free cash flow payout, no matter what company you invest in, you do want to see consistent increases over the longer term. What we can see, pretty inconsistent year on year. It hasn't really moved too much over the longer term, and in fact a massive drop into 2023. What is positive to note, however, 2024 they are anticipating growth to $5.37 per share. In terms of sales growth, well, you could argue this is a very cyclical industry. 5 of the last 10 years have been negative growth. Nice that the more recent years have been positive. Nice double digit as well on the trailing 12 month. And when we look at it numerically, we can see it has in fact decreased 17.7 billion to 15.2. And this is why we always talk about inflation, because if they're not increasing their top line at a minimum of 3 to 4%, then in real terms you could argue they are decreasing their top line. Shares outstanding, well, as always, we love companies that do share buyback, returning excess cash as just one form of that to shareholders. 704 million in 2014, 574 over the last 12 months. So that is one positive from this company. ROIC then, as always, return on invested capital, incredibly important. We want to see 10% or more to give us faith management are able to effectively allocate their capital. In fact, it has been decreasing over the longer term. A little bit of a red flag indicator, something just to keep an eye on. 8% in the more recent year. Again, I would ideally like to see 10% or more. In terms of operating margin, well, again, very inconsistent, but can't argue too much. It is above the minimums we want to see of 12%. Free cash flow margin very strong up until 2023. Ideally, let's get it back to the levels that we have seen only a few years ago. That will make it very strong and definitely a good contender for one to add in the portfolio. In terms of net debt to EBITDA, so the earnings before interest, tax, depreciation, amortization, remember this does correlate to both dividend safety, balance sheet strength. Below 3 is what we want to see, and these numbers that you see below show the number of years that it would take them to pay off all of that debt net of cash on hand. 0.16, so very low in 2023, but it is expected to increase dramatically into the 2024, but still it is below 3, so again we can see balance sheet does look secure and the dividend does look safe for now. In terms of the valuation, let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And typically on the channel we do deep dives, we run through every single one of these models. For today though, we are going to get straight into the intrinsic value, which is the average of these 3 models that you see on screen. Current price now $106. As always, 10% MOS level, which we execute if we believe it has a wide moat, strong financial metrics, and good forward-looking data. If you believe that for EMR, well, I buy up to 118, then we keep going till it's near the current trading price. And in today's episode, we can see it is around $1 to $2 shy, so we can say it has a 20% margin of safety based on our estimates and judgments. And in fact, Wall Street do see 23% upside over the next year, with a price target pretty much bang in line with our intrinsic value, hence why they do consider this a strong buy for your portfolio. Now, before we do move on to the next stock, just to let you know, we have released our latest free weekly article. If you want access to this or any other articles, all completely free, do click on the pinned comment below. You can start to read straight away, instant access. If, for example, you want to see the websites, the screeners that we use to find high quality companies, that is in this article here. Or, for example, if you want to look at one of our more recent articles looking at 12 high quality undervalued dividend stock. The next company where we have a strong buy from Wall Street, in fact, Alexander Real Estate, it is a REIT, a real estate investment trust, with a strong buy from Wall Street and a double buy from the other 2 analysts. It is trading in the midpoint of the 52-week range, a nice starting forward yield, 4.37%, and a P to FFO of just over 12. Over the last 12 months, no surprises, similar to the rest of the REIT industry, it is down 6%. Over the last 10 years, it is up around 49%, and we can see all-time highs does sit around $223 nearly 3 years ago today. In terms of dividend safety, well, 76, it does look to be safe. Market cap 20 billion, it is a large cap company, and we can see reaffirmed again, similar to the previous company, dividend cut looking unlikely. Now, last recession, they did unfortunately cut the dividend. They had above average growth, but they did trail the S&P negative 68%. And we can see the last full year an above inflationary increase. Over the last 5 years, an above inflationary increase. Over the last 20 years, at a minimum, they are increasing that dividend in line with inflation, and we can see 13 years of consecutive increases. In terms of dividend yield theory, we do get the double undervaluation signal, both on the yield and on the forward P to AFFO. We do also note that the real estate sector is marginally lower at 14. And when we do take a look at the payout ratio, we don't focus on free cash flow. This is a lot more volatile for REIT. We draw your attention to the adjusted FFO, the funds from operation, and we want to see below 90%, which, as we can see here, clearly below over the last 10 years, and in fact 68% expected next 12 months, looking very good for that dividend safety. Adjusted FFO, similar to the free cash flow, the same expectations, consistent increases over the longer term. We did get a little bit of inconsistency, but even since then, when it did drop to 568, it has started to rebound very consistently, and growth is expected to continue over the next 12 months. In terms of sales growth, very strong, typically 5 to 10% for REITs. That is, in fact, a lot better from what we can see, 11% just in the more recent year, 10% on a trailing 12-month basis. And if you do look at it numerically speaking, we can see a lot of consistency on their top line sales and some very nice growth, in fact, around 4 times over the last 10 years. We do have to highlight something though, with REITs, they will dilute your position over the longer term. Main reason for this, they don't retain a lot of that internally generated cash flow, as that is paid out as dividends, hence why this is something very typical. But as always, do bear in mind, some real estate investment trusts will dilute your position at a much rapid rate. ROIC then for REITs, 3 to 5% as opposed to the 10 we want to see for other companies. Now it is fairly low over the last few years, As we said, the minimum we do want to see is 3%, something to think about, maybe incorporated into your margin of safety. And operating margin, we can see a little bit of operating inefficiency. It has decreased over the longer term. Nonetheless, 25% is still looking healthy for this company. We then move on to the net debt to the EBITDA. Now remember, for REITs below 5.5, it has been in fact above that every single year over the last 10 years. Expected to move down over the next 12 months, but very marginal. So do bear in mind, this is a company that does have a fairly high net debt to EBITDA. So again, something you may want to incorporate into the valuation model. As always, you can grab a copy of this model by clicking on the pinned comment below, getting to both intrinsic value and the acceptable buy price of companies in your own portfolio or those on your watch list. So a margin of safety at 10%, indicating a buy up to $127, at 15% around $120, and at 20% again not too far off, but today's episode we would say between a 15 to 20% MOS level. In terms of Wall Street and their forecasts, well, they have a price target $143. As we can see, 24% upside. Again, similar to Emerson Electric, they do consider this a massive strong buy and a huge consideration for your portfolio. We then move on to Sanofi, ticker symbol SNY, another strong buy from Wall Street, a buy from Seeking Alpha, but a hold from Quant. We can see it is trading in the mid to lower end of the 52-week range. Again, another nice yield, 4.41% on a trailing 12-month, and a forward P sitting around 11.3. Now, over the last year, it is down around 7%. Over the last 10 years as well, what a roller coaster, it is down around 14%. Dividend safety, well, very safe, nice to note. Market cap 116 billion, a mega cap company. And again, we can in fact see that just last month it was reaffirmed. Dividend cut for Sanofi looking highly unlikely. Now, the last recession, well, they did increase the dividend. They had above average growth, and they did as well outperform the S&P with their negative 42% return. Just a few months ago, they had a nice increase of 5.6%. Inflationary increases over the last 5 years on average, and nice high single-digit increases over the last 20 years. And this is a company that has increased those dividends for the last 24 years. Next year, they will officially become a dividend aristocrat when they increase that dividend. In terms of dividend yield theory, well, again, a double undervaluation signal, both on the yield as well as the forward PE. When we do compare it as well, it is significantly lower than the healthcare sector at 16.6. In terms of the free cash flow payout, below 60%, it has straddled around that for the larger part of the last 10 years, 65% in 2023, 63% over the next 12 months. So as long as it doesn't go too far above that, that does look to be strong, and hopefully we can continue with some nice increases to the dividend. Free cash flow per share, well, again, it has increased over long term, maybe not as consistent as we would like to see, but again, we can point out it is anticipated to increase into 2024. Sales growth, a little bit mixed here. We do want to see 3 to 7% consistently at a bare minimum. What we do note though, 2 years have been negative. In the more recent year, just 1% as well to note. Over the longer term though, we can see it has increased 32 billion to 46. They do some share buybacks, although what we can clearly see, very minimal, very trivial, and very inconsistently. In fact, they have bought back, as we can see here, around 70 million over the last 10 years. ROIC, positive to report that it is around the 10% level that we want to see on a consistent basis. 10% in the more recent year for 2023 as well. And when we look at the margins, again, inconsistent. There's no operating efficiency, but it is above that 12% minimum level that we want to see. And the free cash flow margins do look fairly positive. Year on year, we are seeing some very nice numbers. So you could argue it is a fairly strong free cash flow machine. Net debt to EBITDA then significantly below 3. In fact, over the last few years, below 1, anticipated to be below 1 again, not too far off the 2023 figure of 0.85. So we can comprehend why this company does have that very safe dividend score. So let's take a look at the valuation for today for Sanofi, ticker symbol SNY, an intrinsic value of $63. And in fact, we can see with a current price of $47, this should have some nice MOS. 10% would be $57. 15% around 53, 59, at 20% around 50, 44, and we can pretty much see in today's episode for Sanofi a 25% margin of safety. Remember, that is based on the estimates and judgments we have put it through, and we can see upside from Wall Street 31%, price target $61.50, again another serious contender for the portfolio. We then move on to another REIT, it is EPRT, Essential Properties Realty Trust, a double strong buy rating with a buy from Seeking Alpha. It is trading towards the upper end of the 52-week range. Another nice starting yield, 4.13%. P to FFO around 14.61. And over the last 12 months, fairly decent given it is in the REIT industry, which has been battered over the last few years. Over the last 5 years, we do see it up 28%. Dividend safety score, borderline safe, so we can touch upon that. Just under 5 billion. It is a mid-cap company. And we do note it was reaffirmed last month that essentially the borderline safe rating does suggest a moderate risk of a dividend cut over a full economic cycle. In terms of dividend growth, well, last full year in line with inflation. Over the last 5 years, 21%, so it has had some historically large dividend increases, and they have increased those dividends for the last 5 years. In terms of dividend yield theory, then we do have a sense here of reasonable valuation. The yield isn't too far off the 5-year average, and as we can see, the P to FFO is pretty much in line with that rolling 5-year, although we do note marginally higher than real estate's 14. In terms of looking at the adjusted funds from operation, well, below 90% consistently, 66 anticipated over the next 12 months, so hopefully we can continue to see some nice double-digit dividend growth. AFFO as well has been increasing over the longer term, again expected to increase over the next 12 months. And when we look at the sales growth, we do like to see this strong double-digit growth to their top line every single year, 26% just in that more recent period of 2023. And you can clearly see the very strong growth this REIT has gone through just over the last few years. Again, as we mentioned, for the previous REIT, Alexandria Real Estate, they do dilute your position, and we can clearly see that just from the last 6 years. In terms of ROIC, nice to report that it is on the higher end for REITs at 5%. Remember, we want to see a minimum of 3%, so the fact it has been increasing as well is always a good sign. And when we look at the margins as well, operating efficiency with this REIT, 34% in 2016, 62% in 2023. Now finally, the net debt to EBITDA, remember below 5.5 for REITs, it has been decreasing from the 2019 high of 658 and expected to go much lower over the next 12 months, 3.77, so that is a good sign. With this information, the 3.77 expected and the low essential payout, this does give me faith that this dividend does look to be secure. In terms of the valuation, let's jump in, and as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, margin of safety at 10%, we can pretty much see it is trading at that level, so one of the lower margins of safety for today at 10%. In terms of Wall Street and their expectations, well, they have a price target of $29, so upside of only 7%, yet as we saw, they do consider this a very strong buy. As always though, let us know your thoughts. Are you adding to any of these four? Maybe they're on your watch list, or for whatever reason, they're not ones that you want to consider for your own portfolio. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.